Welcome back to my channel. In today's video, we're going to go into the world of investing through a book that has stood the test of time. We'll explore the key ideas, concepts, and strategies presented in The Intelligent Investor by Benjamin Graham. So, let's get started. Before we dive into the summary, let's briefly discuss why The Intelligent Investor is considered a must-read for anyone interested in the stock market. The Intelligent Investor, written by Benjamin Graham and first published in 1949, is a timeless guide to value investing and financial wisdom. Graham, often referred to as the father of value investing, presents a comprehensive approach to investing that emphasizes a disciplined and rational approach to managing one's finances. In this groundbreaking book, Benjamin Graham shares his wisdom acquired over decades of financial market experience. The Intelligent Investor provides invaluable insight into how to make informed investment decisions, manage risk, and navigate the ever-changing stock market. Graham teaches us concepts like Mr. Market, where he emphasizes the importance of emotional restraint and rational thinking when investing. Additionally, he introduces the concept of value investing, which focuses on buying undervalued stocks with a margin of safety. One of the cornerstone principles outlined in the book is the idea of a margin of safety. Graham explains how investors should aim to purchase stocks below their intrinsic value, thereby minimizing potential losses and maximizing potential gains. Investment versus speculation. Graham begins by distinguishing between investing and speculation. He argues that an investor focuses on the long-term intrinsic value of an asset, while a speculator tries to profit from short-term market fluctuations. Graham encourages investors to adopt a defensive approach and avoid speculative behaviors. 1. Mr. Market and market fluctuations. Graham introduces the concept of Mr. Market, a metaphorical character who offers to buy or sell stocks every day at varying prices. He emphasizes that investors should not be swayed by Mr. Market's emotional swings and should instead base decisions on careful analysis of a company's fundamentals. Graham encourages us to embrace market fluctuations by viewing them as opportunities rather than threats. We'll discuss how the book guides readers to maintain a long-term perspective and stay clear of short-sighted trends in the investment world. 2. Margin of safety. One of the central principles of the book is the concept of a margin of safety. Graham suggests that investors should only buy stocks when they are trading significantly below their intrinsic value, providing a cushion against potential losses. 3. Fundamental analysis. Graham discusses the importance of fundamental analysis, which involves evaluating a company's financial statements, earnings history, and overall business health. He encourages investors to focus on companies with consistent earnings, strong balance sheets, and competitive advantages. 4. Long-term perspective. The book emphasizes the value of a long-term perspective. Graham believes that short-term market movements are unpredictable, but over time, the market tends to reflect a company's true value. Investors should have patience and resist the temptation to make impulsive decisions. 5. Active versus passive investing. Graham addresses the active versus passive investing debate. He suggests that individual investors are generally better off taking a passive approach by investing in diversified index funds or well-researched value stocks rather than trying to beat the market through active trading. 6. Analyzing stocks and bonds. The Intelligent Investor, you will learn how to evaluate companies' financial statements, analyze stocks and bonds, and identify potential red flags that could impact your investment decisions. 7. The investor's behavior. Lastly, Graham discusses the psychological aspects of investing. He highlights the importance of emotional discipline and the need to avoid succumbing to fear and greed, which often drive market behavior. Here are some additional insights, examples, and case studies that provide a deeper understanding of Benjamin Graham's principles from The Intelligent Investor, and it also explains how they apply to various real-world investment scenarios. 1. Margin of safety example. Benjamin Graham emphasizes the importance of buying stocks at a price significantly below their intrinsic value. For instance, consider a company with an estimated intrinsic value of $50 per share based on its financials and growth prospects. Graham might recommend purchasing the stock only if it's trading at, say, $30 per share, providing a 40% margin of safety. This buffer helps protect against unexpected declines in the stock's value. 2. Mr. Market metaphor. Graham's analogy of Mr. Market illustrates the market's volatility and emotional swings. Imagine you own a stake in a company, and Mr. Market offers to buy or sell your shares every day. Some days he's euphoric and offers high prices, while other days he's despondent and offers low prices. Graham suggests that instead of blindly following Mr. Market's moods, investors should conduct their own research to determine the true value of their investments. 3. Cyclical industries and value investing. Graham's principles are particularly relevant in cyclical industries, such as commodities. During a commodity downturn, companies in these industries might face significant stock price declines due to market pessimism. Graham's approach encourages investors to analyze the underlying business fundamentals and buy when prices are low, taking advantage of the market's overreaction. 4. Case study. Market bubble and crash. The dot-com bubble of the late 1990s and the housing market crash of 2008 are real-world examples of how markets can become irrational and detached from fundamental values. Graham's principles of caution, avoiding speculative behavior, and focusing on intrinsic value would have helped investors navigate these turbulent times more prudently. 5. Diversification and risk management. Graham emphasizes the importance of diversification to manage risk. Consider an investor who puts all their money into a single stock. If that company faces financial trouble, the investor could suffer substantial losses. Instead, Graham advises spreading investments across different industries and asset classes to reduce the impact of any single investment's poor performance. 6. Value investing in modern times. Graham's principles continue to influence prominent investors like Warren Buffett, who was Graham's student. Buffett's investment strategy, often referred to as Buffettology, is deeply rooted in Graham's value investing philosophy. Buffett's investment in companies like Coca-Cola and American Express exemplifies the long-term, value-focused approach advocated by Graham. 7. Behavioral finance insights. Graham's book touches on the psychological aspects of investing. Behavioral finance research supports Graham's view that investors often make irrational decisions driven by emotions. Examples include panic selling during market downturns and chasing after trendy stocks without proper analysis. 8. Dividend investing. Graham suggests that investors consider dividend-paying stocks as they provide a tangible return on investment. Companies with a history of consistent dividend payments often reflect financial stability and strong cash flow. Dividends can provide a steady income stream and act as a form of interest on your investment. 9. Investor versus speculator mindset. Graham underscores the difference between investors and speculators. An investor takes a disciplined, analytical approach, while a speculator tries to predict short-term market movements. Case studies of investors who held onto solid companies through market downturns, ultimately profiting as the market rebounded, illustrate the benefits of adopting an investor's mindset. Conclusion. And there you have it, a condensed summary of the intelligent investor. Whether you are a novice or an experienced investor, this book provides timeless wisdom to help you navigate the complexities of the stock market. Don't forget to check out the link in the description below to grab your own copy. If you found this video helpful, make sure to give it a thumbs up and subscribe to my channel for more valuable content. Thanks for watching, and until next time, happy investing.